Hey there, everyone out there in social media world. It's Mitch Goldberg from Be the Boss of Your Money, my live stream show. Thank you so much for joining me. We're getting a bit of a late start. We had a lot of technical difficulties today. I've probably done about 200 live streams and I've never actually encountered today's issue, but apologies to my guest that I was supposed to have on, Christine Lukin, financial coach and author. It just wasn't meant to be today. We tried everything, and after about 20 minutes of trying, we had to call it. We just had too many technical difficulties. I tried to do a solo show, more technical difficulties, and I just got things up and running, more so now to test it out and make sure that my equipment still works, or if I have to throw my computer in the garbage and get a new one. But so since I have you on, I'm just going to do a quick live stream, and we're going to run the intro in a second. All right. So I appreciate all of you staying with me. Put this up. You're watching Be the Boss of Your Money. I'm going to throw my what are we going to talk about today? So let's do that real quick. Okay. So the Fed concluded its 2-day June meeting today. Markets are off a little bit, but nothing crazy. Stocks were down a little bit more earlier after the Fed meeting at about 2:00, and stocks bounced off their lows for the day. But nevertheless, let's just run a quick intro. I'm going to tell you what changed with the Fed, if you should be concerned, and if you're overly concerned, you're probably doing something wrong. So is the Fed making a big pivot today? Pivot! No, they're not. A little bit of a pivot. So let's run the intro. We're going to talk real quick about this. Okay, we're back. I'm Mitch Goldberg. If you're joining me just now, we're talking about the market, today's stock market action, and what changed with the Federal Reserve after its big and very heavily anticipated two-day meeting. That was today. Okay, so what changed? The Fed has basically said that they want to hold off on tightening, reining in their bond buying program, and they don't want to raise rates until maybe 2024. That's starting to change. They're acknowledging the big uptick in inflation that we've all been seeing. And the Fed, for the longest time, and I'm still in this camp myself, has been saying that the inflation we're seeing is transitory. I've been saying that I don't think it goes all the way back to prices at the peak of the pandemic, the economic shutdown. But we'll probably get to prices back to about 2019. But there's a lot of supply disruptions, things like that. We're going to get back on track with that. Cost of labor is going up. Wages are going up. But a lot of that is one-time bonuses, sign-on bonuses, and short-term incentives to get people back to work. But as more people do get back to work, labor market gets a little bit more competitive. I don't expect these bonuses and sign-on incentives to stick around. I don't think they're going to be necessary. A number of states, about 10 or 12 states, have now stopped paying out the federal unemployment benefit, $300 a week. And it'll be a nice experiment to see if the labor shortage in those states improves. I think it'll help. I really do. I do think that'll be a big help. But everybody's getting rid of the federal unemployment benefit in September anyway, because that's when the program ends. So, but it'll be nice. It'll be interesting to me to see what happens. So today the Fed comes out and says, we acknowledge inflation is running hot. They've updated their forecast from about 2.4% to 3.4% inflation this year. And they're saying that, hey, you know what? We'll rein in our bond buying, our version of current quantitative easing, where the Fed buys right now $120 billion worth of bonds every month. They buy 80 billion of Treasury securities and 40 billion of mortgage securities every month to keep pumping money into the market and into the economy, and to keep interest rates, long-term rates, low. So the Fed's not just trying to The Fed controls the shortest of short-term rates, but now they control long-term rates. Okay. They're going to get out of that business of controlling long-term rates. It's typically the job of investors to control of the overall market. But now that we're here, the Fed looks like it's starting to blink. It's kind of like being very brave before a big game, and you're going to do this, you're going to do that. But about 5 minutes before the game, you see your competitors hitting the field, you start to get nervous and you start to think, gee, I hope I wasn't overly confident. And I think that's what's happening with the Fed. They're starting to, it's easy to conceptualize and talk about inflation going up and we're going to do things to control it, but it's transitory. But once you're in that point of inflation, like we are now, that's when the stuff hits the fan and you have to really be brave and stick to your convictions. You have to hold on to the courage of your convictions. But the Fed is saying, hey, they're saying, hey. Now, I don't think Jerome Powell said, hey, but the chairman of the Federal Reserve is Jerome Powell, and he did not say, hey, I think inflation is going higher than we thought. He said, we continue to monitor the situation. We're upping our forecast this year for our inflation forecast, as I said, to 3.4% for the year as opposed to 2.4%. Some Federal Reserve board members have made their prediction for raising rates into a little closer. They pulled those predictions, just two of them. I'm not sure who they are yet, into 2023 instead of 2024. So the Fed's acknowledging that inflation could be a little bit more persistent, a little longer lasting than they thought. They still don't think that inflation expectations have risen a lot. They still think that this is transitory, and that's what they're sticking with. So today's announcement, again, acknowledging that inflation is running even a little hotter than they expected. They still feel that it's transitory. There is something in it for everyone in what the Fed delivered in Chairman Jerome Powell's post-meeting remarks today. And I don't really think much has changed. Maybe the Fed starts pulling back in their bond buying program a little bit sooner than people thought, but it's sooner by maybe instead of 2 years, it happens in a year. I think we all pretty much expected the Fed to start reining in their bond buying by the end of 2021 anyway. So if they do it in September or if they do it next December, I don't think that's what makes a difference. And he did say, we don't want to create a market event. So we want to give investors as much advance time as possible, as much advance notice as possible. But he said, ultimately, we do plan on taking corrective measures if inflation doesn't cool down sooner than we expect, or if inflation is more persistent than we expect. So they're kind of they're being data dependent, which is a good thing. The Fed's crystal ball, believe it or not, is not going to work any better than yours and mine. And that's what they're doing. So that's the update today. Markets have been flat, coming off a little bit recently. Yes, I know the S&P and Nasdaq hit some records, but a lot of stocks have been coming down, especially the economically sensitive stocks like banks. Financials have been coming down a little bit, materials. So banks actually did well today because of the longer term rates went up slightly while short term rates are still grounded. So even if the Fed gets out of the bond buying business, it's going to be at least 2 years until the Fed raises short-term interest rates. And in that time frame, we do expect longer rates to go up, which is actually good for the bank sector because it makes the yield curve slope a little bit higher. And just when the yield curve goes up, it means banks make more money lending money, and it incentivizes banks to lend more money too, by the way. So let's just take a quick look at, we're not even going to be able to do that. Okay, so let's go to camera 2. Okay, we're back to camera 2. So now we're camera 1. Now, so the markets are off a little bit. Dow is down about 265 points, less than 1% down. NASDAQ was off 0.25%. S&P 500 was off 0.5%. Gold was off 2.3%. No great shakes. What else do we have to look at? The VIX is up a little bit, up to 18, still under 20. And I think as much buildup as there was, this is pretty much a ho-hum event. And I just want to say that if you're a long-term investor, and even if you're in retirement already, and your financial future depends on any given Fed meeting or announcement, I hate to tell you this, but you're probably doing something wrong. You should have a portfolio that takes into consideration multiple multiple forecasts, multiple changes to the economy, Fed policy, inflation, interest rates, etc. It's a compromise, and that's why we diversify. And diversification is a strategy that we use to mitigate risk. It doesn't necessarily protect your portfolio from going down in a generally down market, but the point is your portfolio should be prepared for multiple scenarios with regards to the economy and the stock market and your own personal financial situation so that you could stick with your plan. Thank you so much for watching, and I'll see you tomorrow. Bye.